Hey, welcome back. Since the spin-off from AT&T and the merger with Discovery, Warner Bros. Is down significantly. Despite all the competition and opposite to the stock, the business is not doing that bad. We can see a decrease in revenue, but as you're about to see in a second, the company itself is fundamentally getting better and there is quite a bit of potential. Now, the net income is negative, but 8 billion of that 3.1 billion loss is in depreciation and amortization. Is that really a relevant loss, especially for a company like this? Anyway, the amortization will decrease significantly in the following years, so even if everything else remains the same, they'll have a positive net income in a year or two. On the other hand, the free cash flow, which shows a much better image, was always positive and doubled to 6.2 billion last year. This, for a market cap of 20 billion, is extremely undervalued. To get an idea, they could theoretically pay 25% dividend per year and would still have money left. Or they could buy back a significant amount of shares, any of these having the potential to make the stock go up a lot. If they announce a distribution policy, I think this can easily jump 20-30% on the day of the announcement. I saw people talking about an underlying issue because of the difference between the net income and the cash flow, but this is just an accounting loss. Not to mention that these intangible assets that are behind the amortization often don't actually lose the value. Again, it's just accounting. You know, there is a similar reason why real estate investment trusts don't rely on the net income and instead present things like the AFFO, for example. Because the depreciation when you have like 10 or 20 billion of real estate would be massive, but in reality the properties often actually grow in value. If anything, this is good for tax purposes, which is one of the main reasons why depreciation and amortization exist. Anyway, the future fall in amortization resulting in a potentially big net income should basically debunk this issue and could attract the market's attention. And keep in mind that they were affected by the massive strike that lasted for close to 5 months last year, and it obviously had an effect on the profit. Without it, again, even with everything else remaining the same, that should be a pretty big increase this year. I tried looking into what may be behind the gap in valuation, and what I found is just a bunch of terrible short-term-minded arguments that should be debunked in like a year when things normalize. And look, I don't have a position in the company, I'm just telling you what I see from a neutral point of view. They have 14.2 billion in current assets, which almost covers the current liabilities. Even with 35 billion in goodwill, there is a bit of a margin of safety, but the value of the intangibles and content rights is not that easy to evaluate. They managed to lower the debt a lot from 2 years ago, most of it having a relatively low interest of around 4.5%. Plus, very importantly, everything has a fixed rate. We can see that the debt is spread pretty well, so it shouldn't be a significant issue for the company, so overall they are fine from a financial point of view. By the way, a significant amount of debt is due after 2040 to even 60, and you can see all the maturities on the screen. They target a debt to EBITDA ratio of around 2.5 to 3, after which they are likely to focus on dividends and buybacks. That would be the equivalent of around 30 billion in debt, which given the cash flows would be achievable in 3 to 5 years or maybe even less. So that's another thing that can unlock value in the future. Now, about the streaming business, HBO is among the top players in the industry. Maybe they aren't as big as Netflix or Disney+, but they still have a lot of intellectual properties, and this is ultimately a very important advantage. Amazon has recently paid 250 million just for the rights to the Lord of the Rings franchise, and in the future, this type of deal should get more and more expensive the more these big companies have to fight for them. Disney has the biggest advantage after buying Fox, but I'd say Warner Bros. Is the second with all the Warner Media, Harry Potter, Game of Thrones and so on. I think they recently started improving these shows in terms of quality, and I know they are reworking pretty much everything related to Justice League, Superman, Batman and so on. The success of these series and movies can be a big catalyst for growth, and it can attract a lot of attention from the market. I mean, Netflix, a company that just now managed to make pretty much the same cash flow, is valued at more than 10 times than WBD. They also make a bit less than Disney, yet they are valued at 10 times less again. So there is a lot of money interested in the industry, and good performance can attract some of it to this company. I'm not saying they can 10x overnight, but compared to the competition, they are very cheap. Now, with a relatively low valuation for all the IPs they have and a lot of rich competition, there is potential that a company like Amazon or Apple, if allowed, could simply buy them. I mean, the amount of IPs that you can endlessly milk you'd get for 40 or 50 billion should be worth it, plus the rest of the business, and you know that everything is already very profitable. Based on the current cash flow, if they are bought for let's say 40 billion, that's actually pretty similar to the ratio for which other companies buy coal miners today. About half a decade ago, Disney paid over 50 billion for Fox, and Warner Bros. Has arguably much more powerful IPs than that. Again, over half a decade ago, so in today's money that's like 66 billion just accounting for inflation, plus the higher value it has in today's limited market. You know, just Marvel's traditional competitor and all the potential it has should be worth a lot. Something interesting I noticed in the daily chart is that there is barely any volume. The market is not buying nor selling this. How often do you see the price not moving up or down for 5 whole minutes with such a big company? For them, about a third of the day is the stock staying flat. I can show you unknown $1 billion companies with more activity. I think since the spin-off from AT&T and merger with Discovery, the original AT&T shareholders that got shares in WBD probably slowly got rid of it. You know, there is no dividend, people worry about the debt, the net income is negative, so at a first glance and without some research, they probably wouldn't want to hold something like this. This really feels like a forgotten stock after the spin-off, and many people who got it without buying probably just decide to cut the losses and move on every day. As for valuation, I think 3 scenarios should be more than enough to get an idea about this investment. In a bad scenario with competition and things not going in their favor, let's say the cash flow drops back to 2.5 billion. Assuming that the market is trading them at 8 times this amount, that's a market cap of 20 billion, meaning a price of 8.2, so basically the current price. So you can see that from a free cash flow perspective, the current price is already very conservative. Even in this scenario, the debt wouldn't be such a big problem, especially if they refinance a bit here and there. Just to be conservative, let's assume that in a neutral scenario, they stabilize at around 4 billion per year. For a ratio of only 10, which would be the lowest in the industry, that's a market cap of 40 billion, so basically a 2x from the current price. If they spend around 2.5 billion for the debt, that's enough to pay 1.5 billion as dividends and buybacks. That, for the current price, is a very good yield of around 7% Now, in a good scenario with successful rebrandings and debt repayments increasing the cash flow, let's say they keep making 6 billion per year. Assuming that the market begins to pay attention to it and is trading them at 15 times that amount, that's a market cap of 90 billion. That's a price of 36.89 for a roughly 330% profit. And you know, I think this is actually pretty realistic, and it's not some crazy growth assumption or something, it's literally them doing what they currently do and the market recognizing it. So for me this is definitely a very interesting price and I'm considering opening a position. Overall, I really don't see any good reason for WBD to be so cheap. The debt is well spread in the future, they are very profitable and they have quite a few competitive advantages. Even in a conservative scenario, the margin of safety seems very good and I think there are several catalysts that could unlock a lot of growth. If they decide to pay a dividend or do buybacks or both after they are done with the focus on paying down debt, I think this would easily jump. And you know, with all that money, they have the potential to be a very good dividend payer. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.